Let's bring in Scott Bauer. We have the CEO of Prosper Trading Academy joining us here this morning. Scott, welcome. Happy Tuesday to you, and thanks for sharing part of yours with us. Good morning to you. I hope your surgery's gone well and you're recovering from it. I saw the post on Twitter the other day. I just wanted to begin with PPI here. This was a closely watched number after last week's CPI. Again, we're talking Consumer Price Index 40-year highs. You've got the Producer Price Index on a year-over-year basis. I see in line with expectations at 10%, and PPI on a month-over-month just below expectations of 0.9, also below prior, which was 1%. Actual came in at 0.8. Again, at elevated levels, but not necessarily topping expectations, so that could ease back some of those concerns that we saw yesterday. I'm watching treasuries, which are getting a little bit of a lift. The indices are holding on to positive territory still.
Yeah, we got a little bit of a spike here. I think S&Ps were up maybe 7-8 points before the number here. It looks like they spiked up to about up 20 or so. And even though this is a very hot number, maybe it's not quite as hot as what people expected, at least the month over month at 0.8. So, the bottom line is this number here confirms the U.S. companies are still continuing to raise prices at a pretty alarming rate. That year over year 10% number came right in line, but it's the month over month. So maybe, Ben, things are just easing a little bit. But again, this is one print. It's a very important number that we look at, but it's one number. It's a one-off. We can't just look at this and say, okay, things are starting to moderate a little bit. I don't think we're in that camp yet.
I'd agree. And as I look at the core PPI number, last month 0.8 got revised up to 1%, so a higher revision there. And the core month over month did come in at 0.2, so down below the expected 0.6. And the year-over-year core PPI came in. Well, there are the numbers. We can see at 8.4. The bottom line is what I was talking about. As you just mentioned, again, a couple coming in below expectations. But, Scott, we always talk about how this doesn't necessarily equate directly to the consumer. And I mentioned as I brought you in, CPI coming in last week at 40-year highs. But also here, Scott, we've been hearing a lot of talk about how this may not really factor in some of the recent run-up we've seen in crude oil prices up to the 130 level. But I guess when you consider the short amount of time that they spent up there, maybe it's not as big of a consideration to be had.
I agree with that. And we spent the time between, let's say, 110 and 130, literally just a matter of days.
Couple days, yeah.
So exactly. And now we're, sub 100 again. But I think what's going to be really important is looking tomorrow, while everybody obviously is going to be waiting for the Fed, we also get our February retail sales number tomorrow. That may start to show where the consumer is saying, you know what, this is starting to affect us. Maybe we've got to pull back a little bit because we haven't really seen that yet. So I think tomorrow's retail sales number is just as important, really, see what the average person is doing and how, this massive rise in inflation has really affected their pocketbook.
I like that. Again, a good reminder in terms of another data point to keep an eye on. It's not just the Fed. It's not just the inflation data this week. We do get some consumer information here in terms of some of the trends we've seen as far as spending habits. I just noticed that New York Empire State Manufacturing number, we put it up, down 11. They were looking for an increase of 7. Yeah, that was a disappointment. I mean, it really shows kind of the murky waters that the Fed has to deal with and some of the ups and downs that we're seeing in terms of the economy as it recovers from the pandemic. This is a pretty good example thereof.
Absolutely. I think that's the first negative number since the beginning of the pandemic. So, maybe that's also going to feed into what I was talking about with tomorrow's retail sales number. Maybe things are, really starting to show through the cracks now. But, let's all take this in stride. Again, the volatility that we have seen across, I'm not talking about the equity space here, but across the commodity space, has been something that, maybe we haven't experienced even in our trading lifetimes, right? To see these kind of spikes and dips, not just in oil, but across the rest of the commodity space. Again, you mentioned it earlier. Look at gold. Gold is, down at its 2-week low. We got the spike up finally. Now it's pulling back. So there's a lot going on right now. And I don't think there's any one specific data point that we can look at and say, oh boy, this is the one.
Yeah, I kind of think of things right now as, we always talk about establishing a bigger picture concept, an idea, and understanding of markets, the economies on the global level, kind of like a puzzle as we put pieces together. But it seems like it's sort of like a panoramic puzzle right now as we sort of lose sight of what's off to the left. We're still kind of building that puzzle off to the right here. And to your point, in terms of that negative number, just to speak to, we actually did have a negative number in January, Scott, down 0.70. Okay. But before that, I'm going all the way back to, and it looks like May of 2020, where we were down. June of 2020, it looks like slightly lower as well. But in between then and now, we saw upwards of 43. I mean, mid-high 30s. So it really speaks to how that New York manufacturing number has come off significantly. Let's talk about the U.S. dollar. It's been, holding bid levels against the yen. We're talking 5-year highs. The euro currency, you can understand where some of the weaknesses come into play there. But we've got the Fed, which has been supporting things. You have the geopolitical tensions, the safe haven tendencies. Simply put, the greenback has benefited.
There's no question about it. It has. But, maybe here also we're starting to see just a little bit of weakness as, the commodity volatility that we're seeing as commodity prices are coming down, as there's, people fishing for any sort of positive news about what's going on in Russia, Ukraine. I saw that, this morning, I think the reason that oil is down so much is because Russia is now maybe saying that they're going to look at the Iran agreement. So that's why that's down. And I think that all feeds into the dollar, why we're a little bit weaker. But you're right. The dollar has been supported by everything that we should, believe that it would be supported by.
I'm hearing Iran could add some 1.3 million barrels per day. Not enough to offset Russia's loss, but also the OPEC monthly oil report today could move markets. In terms of expectations this week from central bankers, we have the Fed, and then we also have the Bank of England, Scott.
Absolutely. And like you and Chris were talking about, I think, CME futures are pricing in a 99+% chance of the quarter hike. And it's really going to be what he says. The market knows it's going to be a quarter. Is he going to say, well, we're still kind of taking things in stride? And obviously, I'm talking about Powell right now. Or is he going to say, yes, we need to be aggressive to combat this, and it's just a factor of what's going on overseas that's holding us back? So everything is going to be hinged upon what he says, not what the ultimate decision is, because I think we know what that is. In terms of what's going on with the Bank of England, I mean, I think they're going to, probably they're almost in the same position as Powell and the Fed is. They need to raise, they want to raise, but, the economy right now is saying, maybe with what's going on a little bit closer to home for them, maybe what's going on for them, we need to, just be careful is obviously what's going on.
I'm looking at treasuries right now. The future's slightly higher. The bonds, the 10-year, the 2-year. Scott, I'm sure you noticed yesterday a big move to begin the week with the treasuries to the downside. We closed out last week talking about the 5-year and the 2-year lower, the shorter end, but yesterday the 10 joined in. The bonds really joined in. We saw a rate spike. Maybe everybody was kind of gearing up for a bigger number than we actually got today in terms of the PPI as we've come off those levels a little bit here right now. Maybe a little more level-headedness prevails at this point.
That was a massive spike. What did we hit, 211 or 212 on the 10-year? And that happened really quickly. And I think you're right. There may have been an anticipation ahead of today's print. But again, I think that this really comes down to what Powell says tomorrow. And the new level maybe on the 10-year is probably 190 to 220. So raised from that maybe 170 to 2% level that we've seen pretty consistent over the last few months.
Scott, we've talked a lot about the Fed, retail sales, some of the data points, some of these markets, financial markets, and kind of sprinkled it with some of the commodities as well. Aside from what we've covered, anything that's on your radar that you think that we should touch on?
I think it's such a speculative market right now overall, Ben, especially when you look at sectors like the Chinese stock market and some of those Chinese stocks. Yeah, right. I mean, it's almost as if you can't look at technical charts right now because these stocks are just so broken down. And so, I would just give a word of caution to anybody looking to get into that market thinking, oh my God, these stocks are down 70, 80%. They have to go up, right? Well, that's not necessarily the case. So I think we just have to be super, super cautious across the board because we're seeing it, whether it's in equities or commodities, that these markets can literally turn on a dime overnight, during the day. So just be careful.
Yeah, I think that's good advice. And again, these are unusual times. And during these times, I remember as an inexperienced trader, you oftentimes look at the market and you see all this opportunity. But once you're in the trade, you realize the risk associated with it. So again, a good reminder there. Scott Bauer, appreciate you joining us. Thanks for sharing your Tuesday with us. Scott Bauer, the CEO of, thanks to you, Scott, the CEO of Prosper Trading Academy.